Hey everybody, welcome to the whiteboard. In this segment we're going to be discussing intermarket analysis. Now, regardless of the market you're investing in, whether it's the stock market, the bond market, the futures market, the forex market, you need to be looking at the other markets around you to get an idea of what is likely to happen in the market where you have focused most of your investing. If you don't do this, you are basically investing with blinders on. You're not looking around to see what else is happening, what else is impacting the market where you have the majority of your money. So here's how it basically works. Let's say we've got 4 different markets here. We've got the stock market, we have the bond market, and we have the futures market, and then we have the forex market. Now each one of these markets affects the other markets around it. It can have a positive impact on the markets around it, or it can have a negative impact on the markets around it. So typically, the intermarket relationship that many people are familiar with is the intermarket relationship between the stock market and the bond market. If stocks are going up, typically bonds are going down in value, and the opposite is also true. If bonds are going up in value, stocks are typically going down in value. So these markets can have a negative impact on each other, and they can have a positive impact on each other. Now as we look at, say, the forex market, and let's say the value of the US dollar is going down, well, that can have a negative impact on the value of bonds in the US bond market. Or vice versa. If, let's say, bonds are going up, they're increasing in value, there's an increased demand for bonds or US treasuries, well, that can have a positive impact down here on the forex market in the value of the US dollar. If US treasuries are going up, the US dollar is probably also going up. Now looking over here with the futures market and the forex market, let's say the value of oil is increasing and other commodity prices are increasing. Well, that can have a positive impact on some of the currencies in the futures market. There are some commodity-based currencies like the Canadian dollar or the Australian dollar that would benefit from rising oil and commodity prices. However, that could also have a negative impact over here as well, as typically when oil prices are rising, the value of the US dollar is declining. The futures market can also give us some great insight as to what might be happening in the stock market. If we see the stock index futures increasing in value even before the stock market has opened for trading on a particular day, maybe there was some news in Hong Kong or China that have boosted investor spirits, and they are starting to buy the index futures for the US stock market on the S&P 500 or the Russell 2000, and you see those futures prices increasing, well, then you know that stocks at the open are most likely going to be up. The inverse is also true. So you get all of these indications back and forth of what might be happening in the markets by looking at the markets around them. So if you are interested primarily in investing in stocks, you should be keeping an eye on the bond market and on the futures market and seeing what's going on there. If you're primarily interested in investing in currencies, you definitely need to be watching what's happening with the treasuries, the US treasuries, or the government debt that other countries around the world are issuing. You need to be looking at the futures market, knowing what's happening there. And so really what you need to do as an investor is you don't have to know everything about everything, but you should be aware of the general trends that are happening in each one of these markets, so that as you see those trends start to reverse, or if they show signs that they're going to continue for a while, you can look at that and say, okay, how is that going to impact the investing that I'm doing in the stock market or the investing I'm doing in the currency market? Because there isn't one single market that always leads the other markets. Oftentimes, one of the markets will have something happen in it, and that will send a cascading ripple effect through the other markets. And so if you just watch for the big picture news and see what's going on in these other markets, you are going to have a heads up of what may be happening in the market that you're investing in. So with intermarket analysis, you want to make sure you're aware of what's happening in the broader economy, because everything really is interconnected. And if you know what's going on in the broader economy, you're going to be much more effective in investing in the market that you particularly are interested in. So that is intermarket analysis in a nutshell. Thanks for joining me at the whiteboard, and we'll see you here next time.